Here's another spectacular listing by a chipmaker that hopes to compete with Nvidia. MetaX jumping more than 700% on its debut. It made its founder a fortune, reflecting the rise of a new billionaire class fueled by Beijing's drive for self-sufficiency in chips. Live from Sydney, this is Insight with me, Paul Allen, where we dive deeper into the stories that matter with crucial context and sharp analysis. Well, Asian shares tracking Wall Street after sluggish US jobs data did little to boost bets on further rate cuts from the Fed. Despite Chinese equities nearing a correction on renewed economic worries, global funds remain bullish, with China potentially shedding its uninvestable tag for good. President Trump says he's ordering a blockade on sanctioned oil tankers moving in and out of Venezuela as US forces build up in the region and the threat of a land strike looms. And as Roomba maker iRobot gets sucked into bankruptcy and looks at being sold to a Chinese company, we'll get a reaction from one of its co-founders. Helen Greiner joins us with her take on what went wrong and the state of the robotics industry as humanoids become all the rage. Well, Asian stocks are moving in a tight range after sluggish US jobs data failed to revive hopes for more Fed rate cuts. Oil rising after President Trump ordered a blockade of carriers going into and leaving Venezuela, which is raising supply concerns. China is also in focus with the blockbuster debut by chipmaker MetaX in Hong Kong. Its shares jumped more than 700% this morning, a really extraordinary price action there. Let's get some more on the market action. Bloomberg M Live executive editor Mark Cudmore joins us now. So, Mark, China having a reasonable day today, China equities that is. It's been a reasonable year as well up until the past few weeks. We're now off about 5% from the top at the end of October. So where are we heading to from here? Is there any risk of a correction?
I think we're going to have more choppiness over the next couple of weeks. Overall, the bigger picture backdrop suggests we'll see much higher equity prices globally again in 2026. We're still in the inflation stage of the AI bubble. That's a capital expenditure bubble, which is kind of fueling the economy, not just in the US, but globally. We've got the Fed that is providing easier monetary policy than orthodox economics would suggest. And we've got fiscal stimulus coming from around the world. US, Europe, Japan, China, everywhere is kind of pumping money into the system. So it's still, with that, we've got economic growth holding up okay, not brilliant, but it's doing fine. Earnings are okay. So stock prices should do very well. Why am I worried in the short term? Well, as you said, Paul, it's been a great year. We've got some negative short-term drivers. I think one of the issues at the moment is we still have not seen the kind of implosion of the digital asset treasury companies fully play out. That is weighing in the whole crypto sector, and that in turn weighs on retail sentiment and the kind of popular AI names. In that context, we do have very bullish positioning. So I think we're ripe for a bit more of a pullback there. The last 6-7 weeks have been quite tough for equity markets, quite choppy, and I expect that to kind of continue for another few weeks before we kind of get back into the bull market with earnest.
Yeah, we're seeing a little bit of optimism, though, from overseas funds around China in 2026. What are we hearing?
Yeah, absolutely. I think that, people are really starting to register belatedly that maybe China is investable again. That was the theme a couple of years ago, that China is not investable, particularly out of the US, but a little bit in Europe as well. Now, obviously, that story, changed really was it September? I think it was 15 months ago, was really kind of the binary tipping moment for when it became clear that the government in China wanted higher equity prices, and they normally get what they want. They have many tools in the box. They have the power to kind of control these things. They didn't want a crazy bull market like we saw in 2007, and again in 2015. But again, they wanted higher prices year on year in the stock market. So we've been very, very bullish as a team for the last 15 months or even slightly longer. And we think that that's kind of an ongoing sustainable theme. We think that Chinese and Hong Kong stocks will outperform US stocks on a multi-year basis.
Is there some bullishness also coming from this idea, this public debate now happening about the potential for a stronger yuan and maybe some more stimulus as well?
I think the yuan's a little bit of a red herring. Too many people look at it in the context of dollar yuan. Dollar yuan is just a low beta dollar measure. It does not tell you how the yuan is doing. The yuan on a year-on-year basis is having its worst year since 2016. That's because the dollar has fallen so much. Now it's recovered. That's on a trade-weighted basis, not just against the dollar. Now over the last 6 months, it's been recovering on a trade-weighted basis, but again, that's in line with the fact that the Bloomberg Dollar Index has recovered a little bit. So dollar yuan is a little bit of a red herring. What you think happens there really depends on what you think the dollar is going to do, and it will be a lower beta trade around that because it is a managed currency. Absolutely, though, the second part of your question on fiscal stimulus, there is an expectation that the government will provide more stimulus next year. They've continued to do so over the last several years. Not all of it has worked very well, but there is the idea that they still have ammunition, they still have levers to kind of pull, and that they will kind of put some more stimulus into the system. But unfortunately, it may not happen till late in the first quarter, maybe after the Lunar New Year, which is why I think that in the very short term, the path remains rocky, even though I remain quite bullish in the very long term.
Yeah, look, aside from all the bullishness, we do have this ongoing implosion of the property sector, deflation issues, overcapacity as well. Can the optimism overcome all of those factors?
Yes, and I'll tell you why. It's not because the property market is suddenly going to get fixed. That's a structurally broken problem. It's going to take years to fix. It's because the pain there for the stock market has largely already been taken. Property companies, or property, even indirectly related ones, completely dominated the stock market 4 or 5 years ago in China. That's no longer the case. They've already seen that they've already just lost so much that they're now a much smaller part of the indexes, and they don't really matter. And actually, in many ways, the fact that people are no longer gambling on a rampant property market means that they're probably more inclined to put some of their savings into the equity market, especially as it starts achieving year after year gains. That'll be kind of a self-feeding spiral. So the property market's not going to get fixed. Bullishness is not based on the economy suddenly surging. The economy will do fine. It won't do terribly, it won't do great, but it'll do just fine. It's about the fact that the government is going to ensure that more of those gains go towards asset prices, financial asset prices, rather than the property market, and that's why the stock market should do well again next year. And the mainland stock market is expensive, but Hong Kong stock market is still relatively cheap compared to most other major indexes in the world.
All right, Bloomberg MLive Executive Editor Mark Cudmore there. All right, later on we're going to be getting a markets outlook from William Blair and why they think Chinese equities could benefit from more Fed interest rate cuts. Let's get a little bit more on market insights now with Chow, Portfolio Manager and Head of Fixed Income Asia at Robeco. And Chow, thanks for joining us. And I do want to start with that idea around what's coming from the Fed in 2026. I mean, if we take a look at that payrolls data that we got last night, volatile, patchy, a couple of adjectives you could use. And you could also use these numbers in a way to make a case for either more cuts or a pause in rates, depending on your point of view. How do you see these numbers playing into the rates conversation?
Yeah, but I think there's, as you say, the pausing is okay for now, given that, it's a weak number, but not falling off the cliff. And then, of course, there is still some inflationary concern that is expected to come through. So I think holding right now, and there is still expected cuts to come, but we've just had one recently. I think they could pause and wait to see how it goes and give some of that early on next year.
Well, we heard from Raphael Bostic as well. He was saying that, look, the Fed still needs to focus on inflation. What's your outlook for CPI in the US, and is that still the bigger of the bigger part of the dual mandate the Fed has?
I think both. I mean, I think obviously the focus on the labour market has been more predominant of late, but I think keeping an eye on the inflation data and the fact that some pressures could be rising next year due to, some of the feed-through from the tariffs, but also the feed-through from some of the energy prices that may come through as the capex boom in the US continues. So I think those are the things that we're watching and balancing. And say the labour market's weak, but not falling off a cliff.
Okay, so with this in mind, how do you see the spread between the 2s and the 10s heading in the next few months?
We still think a bit more steepening, and the steepening arises much more from the fact that as we go into next year, the refocus on the supply that may come from the Treasury side, but also fiscal issues. Whereas I think we're getting to the point where the short end is being anchored, and we know where that is, and there's maybe a couple of more cuts to come. But that picture is clearer now where we stand.
Yeah, and in terms of the long end, I know you see some potential risks there. Can you unpack those for us?
Yeah, but I think, again, we will have to kind of go... two things that I think that is going to be weighing on us to think is obviously what is going to be happening with the JGBs. As I say, as cuts, that's coming from the US, and at the same time, hikes coming from the BOJ, and the fact that both curves have actually started to move that in that way, that I think the GGB market could be more of interest next year. And for some investors who had actually been in the US assets this year may look for elsewhere. So I think that could affect, and some of that shift into potentially, much more high-yielding JGB markets could be something that we could be watching out for.
All right, well, this is a good time to talk about the Bank of Japan because, of course, we do have that rates decision this week and a very wide expectation. We're going to see some more tightening for the first time since January. Seems like a long time between tightening. So what's the path ahead after this? Do you think there's a case for increasing the pace of tightening here?
I think that even if they are going to, I don't think they're going to want to signal that. I think they're going to be, cautiously reminding us that they'll be slow and be watchful of how this impacts the growth outlook within Japan as well. But having said that, I think the normalization will continue. They've got some real, this has been long awaited, the inflation and the wage numbers are giving them good reasons to, and the fact that a very weak yen also gives an impulse for kind of heading them in this direction. But I think they will try to signal that it would be slow and measured so that things could actually adjust without worrying, without, big unwinds that would disrupt the market.
Yeah, but as you say, there's strong inflation. There's a weak yen. Why the abundance of caution here? Would the market really react that adversely to a swifter pace of tightening?
I think there is concern of unwind that we've seen in the past, which would validate, and particularly as liquidity into year end kind of could be quite tight, that it warrants to not disrupt the market. This, as I said, this cut is pretty well flagged. Probably another couple of this hike is very well flagged, and probably another couple of hikes to come in next year. But I think they could certainly signal that they could wait and see, and they have been actually very cautious in the past in making these moves anyway.
So have you been surprised by the strength that we're seeing in some of these JGB auctions?
Yes and no. I think we had been expecting that, some of the locals, have definitely begun to think, with all the, very high gains that they've had from the allocation to the US market, it is time to kind of maybe think more about moving some assets back domestic onshore. So I think that, and then as we get maybe a stabilization of the yen, it could other global asset managers could be looking into the JGB market as being potentially an interesting play to play next year as well.
Do you have any concerns about the amount of spending and borrowing that we're going to see on the fiscal side in Japan?
So I think that's what's held everyone back, definitely. And the concern there is that we may also be having, as I think the theme for us next year is fiscal across all the different governments. And I think that's where we will be focusing most on. So I think that is going to keep things back, and we'll get concerned about the fiscal. And that's why the steepening. So we still have a steepening bias in Japan as well. But again, going into next year, we can reevaluate that depending on how much the things move. But that is definitely a trade that we're looking to get back into next year.
Well, we've got another rate decision coming up today. Well, two, in fact. We're not expecting any change from Bank Indonesia, but I would be interested in your views on the Bank of Thailand. We're expecting a 25 basis point cut there. Do you feel that this is going to be enough to bring a little bit of weakness to what's been a very strong local currency? And do you feel as if monetary policy is perhaps reaching its limits in what it can achieve in Thailand?
I think there's the Thai baht has been extremely strong, and I think that's much more to do with the gold, the gold trading that is in Japan. I'm sorry, in Thailand, away from the economic situation. So this is a concern. I think the baht could certainly be doing a bit weaker, and certainly could help with the economic malaise there and the tourism issues there. So I think they have to do more than just look to rates. They have to I think they are looking into ways to which they can bolster the intervention in the baht because of the gold trading, and that's actually been the things that's actually pressurizing the strong baht.
And we've also just heard now from India's central bank governor, the RBI, says they expect to keep rates low for a long period. What's your outlook for the Indian economy? I mean, growth's still pretty solid, but the rupee is very, very weak. Where do you see monetary policy heading? Where does it need to be next year in India?
I think they front runted a lot of cuts early on in the year to try to strengthen the economy, and that's worked quite well. I think there is certainly room for another cut, but I think for now the growth is good. Inflation is actually quite good, and actually I think they've done a relatively good job. The currency issue again may be less to do with what they can do domestically, but also to do with a very strong dollar, and the Indian stock market hasn't been as robust as it has been in previous year. But again, we're a bit more bullish there than maybe this year as people reevaluate that India, with its its growth story still intact, that could be an interesting market next year as well. The valuations had been very high, but again, given that everyone else is actually raised upwards, we're quite bullish and looking at the Indian stock market again next year.
All right, Tuha Chow, thank you so much for joining us today. Tuha is Portfolio Manager and Head of Fixed Income Asia at Robeco. We have plenty more ahead. This is Bloomberg. Jared Kushner's Affinity Partners is exiting from Paramount Skydance's hostile bid for Warner Brothers Discovery, and that's as Warner Brothers is said to be planning to reject Paramount's offer in favour of its deal with Netflix. For the latest, let's get to Bloomberg Senior Editor Derek Wallbank in San Francisco. So, Derek, what's next in this saga? Where is Warner Brothers likely to turn?
Well, that's right, Paul. And in fact, they're likely to turn right where they've been the entire time, which is to say that they are continuing to favor a bid from Netflix. It seems like that is so far all steam ahead. Paramount has not necessarily given any suggestion that it is dropping out of this in any sort of way. So they are still very much in a pursuit phase. But this is another indication that Warner's are really sort of going in the Netflix direction. That's kind of where they're going. There had been some concern on the Warner side about the financing of the Paramount offer, as well as some of the conditions therein. It is possible that Paramount could raise their offer. Still, you're seeing an implied stock price that suggests that there may be some investors who believe that a higher bid could be coming at some point. But right now, as I say, this still leaves the ball very firmly in Netflix's court for the initial phase of sort of who gets this. There does, after that, become, as you know, a very complicated process of review to see whether or not this can go clear antitrust and actually get done.
Yeah, let's get to that question in a moment, but can you tell us a little bit more about why Affinity's walked away?
Well, it's it's one of those things where sometimes when these things get to this stage, you start to see, partners change. There had been some question about the role of Jared Kushner in this. Obviously, he has, this is a son-in-law of the President of the United States. That brought some views towards Affinity. Affinity had its own reasons, of course, that it wanted to pull out. But as I say, at this point, that is a partner that was in the financing. It wasn't nearly all of the financing. You're talking about somewhere in the neighborhood of about a $200 million contribution. They said that was kind of a relatively minor amount. So it's not necessarily in any way kind of fatal to a Paramount effort. I don't want to put anything into that sort of context. But they did pull, the Paramount thing, as I say, kind of lives on in there. As I indicated earlier, there is some speculation that Paramount could come back with potentially a higher offer going forward, or maybe a restructuring of how it's putting together its money.
Well, tell us a little bit more about some of those regulatory hurdles, and what's the possibility that President Trump might have something to say about any eventual deal?
Well, Paul, I think that's one of the real key questions that we've got going here, because this is not just a simple M&A issue, right? There is an antitrust question to it all. If you combine two major Hollywood studios, I don't care who you are, you start having these antitrust concerns, even among Democrats, right? There are some Democrats who say this is a classic antitrust case. This should be just nipped off and done. But really, when you're talking about this situation in this White House, there is a lot of question about what Donald Trump thinks, what his administration thinks, and what they're going to be willing to greenlight. Now, Paramount, when you're talking Paramount, you're talking about the Ellisons, right? And you're talking about a family that has been seen as quite tight to the president. I thought it was sort of interesting, some comments that President Trump made, where he was suggestive that 60 Minutes, the CBS News program, has not been, particularly favorable for him. He said, I'll read the quote to you. He says, "For those people that think I am close with the new owners of CBS, please understand that 60 Minutes has treated me far worse since the so-called takeover than they have ever treated me before. If they are friends, I'd hate to see my enemies." That's Donald Trump speaking there. But indeed, Scott Pelley, the 60 Minutes correspondent, a sort of journalistic legend, was saying at the National Press Club in Washington he hasn't seen any sort of interference just yet, corporate interference, in the way that 60 Minutes goes about what it's doing there. So there have been, as I say, there was a lot of questions about what was going to happen to CBS News in that takeover. Donald Trump has been very interested in what would happen to CNN in any sort of takeover thing. Netflix is not necessarily bidding for all of the assets in the Warner Brothers, sort of package. It's not going for all of that, and so that might be held back and retained. And the question of CNN would be an open one. But what is going to sort of trip Donald Trump into saying yes? That is a critical thing.
All right, Derek Wallbank there, Bloomberg senior editor in San Francisco. Thank you. Still to come, we're going to speak with one of the co-founders of iRobot as the company files for bankruptcy and the Roomba brand gets vacuumed up by Chinese ownership. We'll also discuss the future of robotics as well. This is Bloomberg. Welcome back. You're watching Inside. Here's a quick look at where markets stand as mainland Chinese markets head off for lunch. Seeing a bit of a reversal of some of the losses that we've seen so far this week. Most of the major indexes pushing a little bit higher, including the CSI 300. There was some concerns that Chinese markets were approaching correction territory. We do have the CSI 300 down about 5% from its peak at the end of October, but showing some modest gains today. Got the cost Kospi also better by 0.2%. That was one of the worst performing indexes yesterday. Got the yen, meanwhile, not a lot of change there, just hovering below that 155 level. There is, of course, a Bank of Japan meeting coming up later this week. If you somehow managed to miss that news. Also, a couple of other rate decisions today from the Bank of Thailand and the Bank of Indonesia. No change expected in Indonesia. That's likely to be a hold at 4.75%. Bank of Thailand, meanwhile, seen cutting by 25 basis points down to 1.25%. Thailand struggling with a very strong baht. The index in Thailand pretty much flat at the moment. Taking a look at oil prices as well, we have seen the price dropping a little bit on glut concerns. WTI hit $55 for the first time since 2021. But of course, that ever-growing armada off the coast of Venezuela seeing might end up being a short-lived pop in prices there, but overall oil prices looking pretty weak. We're also watching the start of trading for the Indian rupee, which has slid to successive record lows in recent weeks. It's led analysts to debate why the central bank has refrained from intervening. And we did hear from the RBI governor a short time ago saying, well, look, rates are going to stay low for a prolonged period. But the RBI has injected $5 billion to prop up the rupee after it hit a fresh record low on Tuesday. Not a lot to stop the slide, though. We're now at 91, another record. The RBI says it plans to add another $16 billion in liquidity, meanwhile, into the banking system later on this month. Now, we're also tracking a pair of key trading debuts in China today. Chipmaker MetaX, it's not a misprint, surging in Shanghai after its $586 million IPO. It was up more than 700% at one stage. That's the second major chip debut for China in 2 weeks, after a similarly impressive start for more threads. Now, licensed crypto exchange HashKey also rising in its Hong Kong debut after an IPO raising about $200 million. Well, it's off about 3% at the moment. Anyway, it's coming at a tough time for the crypto industry. Bitcoin is under pressure after a second half reversal. Okay, for a little bit more on these debuts, let's get to our China correspondent Min Min Lo in Hong Kong. So, Min Min, let's start with MetaX. That was quite the reaction that we saw on debut. Tell us a little bit more about this chip startup.
Yeah, certainly a very, very strong reaction, even better than More Threads debut over a week ago. And there has been a lot of interest in this startup chip company, which is benefiting, of course, from the domestic substitution theme in China. This is a company that is founded by an ex-AMD employee. In fact, three of the founding members were previously from AMD. And this certainly seems to be the new playbook now for many of these chips companies, following the footsteps of More Threads, which is also started by an ex-NVIDIA company. The founder of MetaX had worked at AMD for 14 years before he left about 5 years ago to focus on his own startup. So it designs and sells GPUs for general computing purposes, for graphic chips, for visual rendering, but also for AI inferencing. And the company said that its latest chips is closing the gap with NVIDIA's H100 chips. And of course, the big uncertainty is now that the U.S. administration has approved the sale of NVIDIA's H200 chips to China, the Chinese government so far has not yet provided a clear guidance for companies whether or not they will be allowed to buy those chips. But certainly if that approval comes through, the green light from the Chinese government as well, that could be a headwind for this company.
MetaX, though, must be said, still makes a loss at this point, but I don't know, considering it's AI, does anybody care at this stage?
Yeah, that's right. It is still making, in the first half of this year, I believe about first 3 quarters of the year, making about 300 million yuan in losses, 1.2 billion yuan or so in revenue. So still loss-making, but similar to More Threads as well, which is also loss-making. The Chinese government has essentially loosen the rules for listing on the star market, allowing some of these unprofitable companies to list as part of its efforts to boost the strategic sector. So yes, it's not going to be the only one that is listing. We are expecting more foundries and chip makers, including Yangtze Memory Technology, Changxing Memory Technology, said to be also looking at potential IPOs on the star market as well.
So MetaX not making a profit at the moment, but what do we know about the outlook, the path to profitability, spending plans, things of that nature?
For MetaX, it probably will take still a few years. We did see last year it was making losses of upwards of 1 over million yuan, and this year, the first 3 quarters of the year, the losses were amounting to about 300 plus million. Last year was above $1 billion. This year was about 300 million plus. So we can see that the path to profitability probably it will be in a few years, given that they have narrowed the gap there quite quickly. But also, I think the Chinese government has provided very supportive policy, and that's why even though we saw this sell-off in the tech sector in the US, concerns over extended valuations or over expansion, especially when it comes to capex spending. In China, we are seeing a lot of interest, especially in some of the smaller cap stocks on the Chinex index, for example, that saw a huge rally in the second half of this year. We are seeing investors increasingly now diversifying to other second-tier companies and looking beyond some of the big names like Baidu and Alibaba.
Well, you've also interviewed the CEO of HashKey, which is another company that's debuting in Hong Kong today. Can you tell us a little bit more about that?
Yes, HashKey is a licensed crypto exchange in Hong Kong, the leading one in Hong Kong. It has about 3/4 of the market share here, but it also has license to operate in Singapore, in Japan, Bermuda, in the UAE, and that really is a key advantage for the company. But this is also a company that is loss-making as well. The first half of this year, we're talking about 500 million Hong Kong dollars of losses. And based on the calculations from our Bloomberg intelligence analysts, the cash burn rate for this company is quite high, and they are likely to be loss-making for a few more years. But have a listen to what the CEO told me in an exclusive interview.
We don't know how crypto prices may fluctuate next month, so we didn't give it too much consideration to short-term market sentiment. It's been 7 years since we established HashKey in Hong Kong in 2018. We feel it's the right time for an IPO. Second, and more importantly, we expect the US to fully establish the core legal framework for crypto finance in the first quarter of next year. We see that as an opportunity for market development. We want to be fully prepared before that, and an IPO is part of our preparation.
Does it mean that you are in the process of obtaining approvals and license to operate in the US, and what is your progress on that front?
We don't have any specific plans to enter the US market yet, but we view it as a huge future opportunity. So we're closely monitoring innovations and developments in US and SEC regulations. We're also very pleased to see that in the past month or two, the SEC and the CFTC have introduced many new regulatory rules around crypto assets and finance. They have clarified many areas, making the rules for the market increasingly clear. So we look forward to the day we can enter the US market.
What is your outlook on the regulatory space in mainland China? Do you think at some point it could match Hong Kong's regulations?
We see that mainland China is investing significant resources to promote the development of the central bank's digital RMB. By doing so, China acknowledges blockchain technology and the tokenization of currency. In fact, there's mutual recognition of some infrastructure from the perspective of underlying basic technology. The current restrictions in China, I believe, are not aimed at cryptocurrencies or digital assets. China has adhered to capital and foreign exchange controls for decades. If the capital is converted into a token, such as a stablecoin, it will impact controls from the mainland. So rules on capital controls need to be set first before allowing the cross-border flow of funds.
Your company is still making losses as of first half of this year. I believe it's about 500 million Hong Kong dollars in losses. What is your path to profitability?
We have a longer-term plan. Currently, I think profitability is not the core indicator for our business operations because the market is developing rapidly, and we still have plenty of work to do, which requires massive investment. However, we pay more attention to our cash flows, which determine whether a company can operate sustainably.
How long will this round of IPO financing sustain your cash flow?
Before this, we had a cash reserve of nearly 2.2 billion Hong Kong dollars on our balance sheet. Based on the cash flow generated by our monthly operations, if the 2.2 billion Hong Kong dollars serves as a supplement to our operating cash flow, it can sustain our future operations for 40 months, which is over 3 years, assuming we don't expand our investments. The IPO will increase our cash flow by more than 2 billion Hong Kong dollars. So together, I believe we can not only achieve a longer period of sustainable operations, but also increase our investments over the next 2 years, a period when the market could develop very quickly.
So the CEO told me that they might be turning profitable in a few years' time, but the IPO proceeds will be used to upgrade the company's technology infrastructure, also to push ahead to new markets. And they're focusing primarily still on Asia before looking further beyond that. But of course, this is a company that has benefited greatly from Hong Kong's loosening rules, right? Because the Hong Kong government has been trying to boost and cultivate this city as a hub for digital assets. So it's benefited from that. It is now one of the few, I believe, one of 11 exchanges that had obtained licenses to operate here. But I think one headwind for this company is that we expect the Hong Kong government to further loosen the rules. Potentially the next phase of that loosening could allow smaller brokerages, mom and pop securities brokerages, to directly tap into international liquidity pools, meaning they might be able to route orders directly onto platforms like Binance or Coinbase, and thereby sort of bypassing companies like HashKey. So that could be a potential threat to the company. I asked the CEO about that, but he is still confident that the regulation is on their side for now, unless he says other companies like Binance or Coinbase manage to get some form of license to operate here in Hong Kong.
All right, Bloomberg's China correspondent Min Min Lo there. We have plenty more to come. This is Bloomberg. iRobot, the maker of the Roomba robotic vacuum, has filed for a pre-packaged Chapter 11 bankruptcy, and the fallout has reached Wall Street. Carlyle Group has lost more than $100 million on a loan to the firm, recovering just $39 million. Carlyle eventually sold the remaining debt at a steep discount to a subsidiary of China-based Pikia Robotics, which is now set to acquire iRobot through a court-supervised restructuring. Now, since its 2002 debut, iRobot has sold over 50 million units of the Roomba and remains a household name. For years, though, the company failed to compete effectively on technology and pricing, mainly against Chinese rivals, and lost market share. Regulators blocked Amazon's $1.7 billion acquisition in 2024, and losses mounted as President Trump's recent tariffs on Vietnam added more pressure. Well, iRobot was founded in 1990 by MIT innovators Colin Angel, Rodney Brooks and Helen Greiner, who joins us today to share her perspective on the company's fate, on robotics and what's next for the industry. And Helen served as iRobot's president until 2004 and chair until 2008. Helen, thanks so much for joining us today. I mean, as I outlined there, it's been a while since you've sat on the boards at iRobot, but this company was your baby. The Roomba was your baby. I'm wondering if you had any feelings about what's happening.
Yeah, I'm a bit heartbroken today. Well, when we heard the news about the Chapter 11 bankruptcy, it's, building iRobot was a dream come true to me because I wanted to build robots since I was 11 years old and saw Star Wars. And we did it. We succeeded. And, there's lots of reasons why it has gone this way, but it's really a shame. It's heartbreaking.
I'm just curious, we have to know, we were talking about this before the show, do you still have a Roomba?
I have many Roombas, including one of the first ones. They do an excellent job. They do an excellent job keeping the floors clean.
One of the criticisms of the company, as we also outlined there, is iRobot failed to switch to LiDAR, which it almost feels like a Nokia moment. I'm wondering, if you'd stayed with the company, would you have recommended a switch to that technology?
I probably would have, actually. I'm really surprised you bring that up. I almost didn't buy a Tesla because it didn't have LiDAR on it. Although I'm really glad I did because it's phenomenal. But yes, I've always been a fan of LiDAR because it can see in the dark and it doesn't have some of the problems that vision will have in edge cases. That's what we call them in the robot field. When things aren't quite what you expected.
It's interesting that you mentioned Tesla and the hesitation you had in buying an EV that didn't use LiDAR. Do you see that as becoming a debate in the EV space, the camera versus LiDAR? And is it the same story? I mean, Tesla's proven it's not necessarily a mistake to avoid LiDAR, but is that the better technology?
I think long term, Elon's right that it will be vision, but in the shorter term, until all the problems have been overcome, LiDAR does work well, especially when you're indoors and you may not want to put headlights on your robot to go around. But when iRobot came out with the vision system, I don't want to take anything away from them. They did a phenomenal job. That was a real breakthrough in being able to navigate at a low cost around a home.
Well, considering how global supply chains have evolved since your involvement with iRobot, do you feel that the company becoming part of the Chinese ecosystem in manufacturing and supply chains was, in a way, inevitable?
Well, we've always manufactured the Roomba in China and now Vietnam, but we always thought it was inevitable. Like what we learned very early on is that the low-cost labor doesn't exist here. The very skilled and intricate construction isn't here. I mean, there's lines of mostly women building Roombas in China and Vietnam. And also, you don't have the supply chain here. It really hasn't set up for manufacturing. There's a price point at which you can manufacture in this country. A car, I know Whirlpool does some washing machines here, but it's extremely, extremely difficult. And don't let anybody tell you otherwise. We certainly would have wanted to manufacture in the United States. And as the value of the robots go up and the costs, what people are willing to pay for them go up, I think they can be manufactured in the United States. But it certainly wasn't possible for these low-cost consumer products or things like high-end toys. It's something that is just not possible.
Well, that is part of the motivation of President Trump's tariffs, is to bring that manufacturing back to the United States. Do you feel that it's going to make a difference for companies, well, maybe too late for iRobot, for other companies that were potentially facing the same situation?
I think it will be hard to get a low-cost consumer product manufactured in this country. But I'm a big fan of the innovation happening in this country. iRobot employed thousands of people. We got 50 million Roombas out there. It was a life-changing experience for a lot of people who worked there in engineering, marketing, and all kinds of other capacities. So I think having that part of it in the United States can work as well.
How would you characterize the current state of competition between the US and China in the robotics space? Do you feel like any one country is leading? Where's most of the innovation happening now?
Well, that's the issue. We were leading. Roomba, iRobot proved that you could have a business around robots. And believe me, when we started in 1990, that was not at all, certainly the case. But we did it. We succeeded. Dream come true. And now it's really, iRobot, the assets are going to a Chinese company. Chinese companies are independently succeeding in this in this field. And everybody's all crazy about humanoids right now. The humanoids coming out of China are I think as good as the ones here, but also at a lower price point because they are concentrating on manufacturing efficiency as well. Now, I don't believe we should just be concentrating on humanoids. I think we should be more innovative in our thinking.
Yeah, I want to talk about some of that innovation in a second, but you mentioned US technology heading to China in situations such as iRobot. I mean, you've also got a background as a US military advisor. Are there any national security implications from these sorts of technology transfers?
Well, I think there are. And there was a huge press outcry when Amazon was going to buy it, a great American company, right? But there's been hardly any outcry that, that data, that information will belong to a Chinese company, which is a little bit bizarre to me. I do like, the Chinese companies I've always worked with have been tremendous partners, but I do wish that the data and everything stayed in this country. And there's secondary reasons why you really need it in this country, and that's the people that learn how to build robots, they go on and they build other robots, and it becomes an ecosystem of robotics, which is one of the things iRobot created. And you need that to happen in this country. And when things start in this country and then go to China, it happened in a bunch of fields, solar cell panels, batteries. They take the small companies when they find it hard to succeed and help them and get them to go to that next level.
Mm-hmm. Helen, we're nearly out of time, but I do want to circle back to that point you made about humanoid robots not necessarily being the be-all and end-all. And I know that your latest product is very not human as well. Where do you see the action heading in terms of robotics in the next couple of years?
Well, I think there will be humanoids eventually. I'm not sure the current generation is the generation that's going to push them out there as products. But I see so many different areas that are succeeding in warehouses, fulfillment centers, manufacturing. There's almost an industry I can't think of that isn't becoming roboticized, and it's a hugely exciting time in the robotics field.
All right, Helen Greiner, co-founder of iRobot. All right, let's take a quick look at how assets are tracking in the Asia-Pacific at the moment. Seeing a little bit of a rebound following the selling that we've seen over the past couple of days. MSCI Asia-Pacific currently better by 0.25%. The Hang Seng Index pushing higher as well. Also seeing a little bit of strength in Japan ahead of the BOJ meeting later this week. Still to come, Rystad Energy is going to join us to talk all about oil as President Trump orders a complete blockade of sanctioned tankers moving in and out of Venezuela. William Blair will also be with us. Welcome back. You're watching Insight. Let's take a look at how markets are tracking at the moment. A little bit of optimism right now. Modest risk on, emphasis on the modest there. We've got the Kospi better by 0.8%. One of the better performing markets in the region today, although it was one of the worst yesterday. We've got the Hang Seng Index also better by 0.25%. Just see on the bottom of your screen there that the rupee is extending its advance against the dollar. We are hearing that the RBI has been selling US dollars in the foreign exchange market to support the rupee. That is according to traders. So we are seeing the Indian currency strengthening a little, now just 90.08. So we're certainly in a better position than we were yesterday, but still very weak currency there. Speaking of weak, let's take a look at oil prices, staging somewhat of a recovery at the moment. We'll explore why in a moment, but WTI earlier touched $55 a barrel for the first time since 2021. So the oil price still under pressure because of supply, but that's not all that's going on with oil. President Trump is ordering a complete blockade of sanctioned oil tankers moving in and out of Venezuela. Now, the move increases pressure on Caracas amid a U.S. military build-up in the region. Oil reporter Nicholas Lua joins us now. So, Nicholas, why is President Trump now blockading Venezuela?
So if you've seen that social media post he put out earlier this morning, Paul, Trump is accusing Venezuela of drug crimes and other assorted crimes. And as a result, he's threatened a blockade around Venezuela. And I think that's a big deal because it represents an escalation on earlier hostile behavior between the US and Venezuela. The US has earlier seized an oil tanker off Venezuela's coast. And as it is, things are very dicey. And now with this new social media post and the threat of a blockade, it looks like things are getting even dicier. But also to add, like oil bulls who've been lamenting weak in an oversupplied market have something to shout about maybe at the end of this year.
All right, so what's this blockade going to mean for oil prices going forward? How enduring is this spike going to be?
So I'll say that in the short term, there are definitely people doing some profit taking, right? Earlier in the morning, after that headline crossed our wire, WTI went up as much as 1.5%. And it's paired a little bit of those gains right now. I think if we look at the grand scheme of things, it's important to remember that while Venezuela is an oil exporting nation, it's in the grand scheme of things, in the global scale, less than 1% of global production, right? So at the same time, like we've seen earlier hostility on Venezuela leading to spikes in oil prices, but those have fundamentally all been eventually erased. So I wouldn't expect this to be more than a blip.
All right. Bloomberg's oil reporter Nicholas Loud there. Now, we also spoke to Phillilps 66 Chairman and CEO Mark Lashier about the outlook for oil prices and refining.
Really, we want to see consistent crude prices. But in the short term, as crude price drops off, we do see margins expand in refining. And currently, refining capacity is somewhat constrained globally. And so generally, we're able to withstand that and maintain or perhaps even expand margins. Now, margins had been contracting seasonally, and so you have a conflation of all those things coming together. But the two big things out there, you had reports that unemployment is up slightly more than expected, which was a downward pressure on crude. And then you also have the potential of peace breaking out between Ukraine and Russia, which I think would be a fabulous development, but near term, that's going to put pressure on crude prices.
Well, I want to talk about that a little bit. You used a great term earlier that when it comes to the geopolitical premium that's in the oil market, it's sell the rumor, buy the fact sort of situation. And as we look into 2026 with, of course, geopolitics top of mind, what does that mean for the broader refining outlook and specifically for diesel as well?
Yeah, we continue to see tightness in the global refining capacity. Even some of the newer assets that are online in Nigeria, Mexico, they're running at, say, 40, 45% or less. You see refineries being rationalized. We ceased operations at our LA refineries. Some of our competitors are talking about rationalization as well. And so globally, refining capacity is tight. And so that's a structural thing that no matter what the crude price is, we should be able to see constructive margins going forward in refining.
Well, can you talk a little bit about the capacity for actual shipping and transportation of that energy? I think we are supposed to get some sort of a green light potentially out of the U.S. government with regards to the Western Gateway pipeline. Are you anticipating, A, that will be approved, and 2, are you still committed to building out?
We're in the middle of open season. That's a process where we see what shippers are interested in moving refined products on that. And that Western Gateway pipeline will move gasoline, diesel, jet fuel from the mid-continent, very competitive refineries, out to Phoenix, California, and Las Vegas. And it'll provide much needed relief for California as refineries are coming offline there. And we think that there's strong support at the federal government. There's strong support in California as well as adjacent states to have that additional supply coming in. And we've got a strong position in the mid-continent. We're certainly going to participate as a shipper on that pipeline. And we've had good response. But that open season doesn't close until the 19th. And then we'll see what things look like from there and decide how big the pipeline needs to be and if the economics are there for us to proceed. But we're pretty confident at this point.
That's Phillipps 66 Chairman and CEO Mark Lashier speaking earlier with Bloomberg. Well, let's get some more on the outlook for energy markets now. We're joined by Janiv Shah, Vice President of Oil Markets and Downstream Analysis at at Rystad Energy. Janiv, thank you so much for joining us. I do want to start, if I can, with a look at a technical chart of oil prices at the moment. I mean, speculators see a potential breakdown here. I mentioned earlier we've got WTI back at 2021 levels. So, as supply just keeps on building, what's your outlook for oil prices next year?
Good day, good afternoon, and thank you for having me on. I think for next year, what we're looking at is a little bit more of a bearish sentiment compared to this year. We have seen for the last 2 or 3 or maybe even 4 years, oil has had annual losses. But if we zoom into the weeklies over the last 3 or 4 weeks, we've also seen something accelerating in downside in terms of pressure on the oil market, total oil market, Brent, WTI, Dubai, and other benchmarks. So looking forward to next year, we are looking at a Q1 average of maybe $61 from $63 this quarter. But that also has some downside risk, of course, with the latest ongoings and within the last few weeks or even last week. Oil has dropped around 4 or 5% in the last 4 sessions. And this is because of the potential peace deal that's coming onto the table and maybe even being accepted between Russia and Ukraine. Now, that is somewhat balanced ever so slightly by the news coming out of the US and Venezuela, as we've just seen in the last couple of hours from the US administration. But nevertheless, we are looking at a very oversupplied market from a balance perspective and from a fundamentals perspective going into the entirety of 2026. So, yes, a bit of downside pressure from here on out.
Well, let's just unpack a couple of those geopolitical factors. I mean, let's imagine that the Russia-Ukraine war does get resolved, that there is a ceasefire, that we start to see some of those sanctions ease. I mean, at the moment, we've got Russian crude prices at their lowest since the war began. If there's a resolution, and I'd be interested in your view on the odds of that happening, what impact would that have on prices?
Well, we see we're increasingly entering or have entered, and we react as a market more to headlines a lot quicker, right? So we're a lot trigger happy and more on the pulse. So, with Russian volumes potentially re-entering the market, those discounts, there's huge, wide, massive discounts on Urals, ESPO barrels as well, could fall away quite quickly, and we could see some more parity for Russian barrels entering the wider market. Of course, the sanctions may not come to an end immediately for anything coming into the European system, but for the US side of sanctions, things could move a little bit quicker as the US looks to shore up the energy availability and, of course, to reduce the gasoline price at the pump for the consumer.
Well, a minute ago we were talking about President Trump announcing a total blockade of sanctioned Venezuelan tankers. So, again, I'll ask you to look into your crystal ball here. How long do you see this blockade lasting? And is that going to give any support to oil prices in the short term, considering Venezuela isn't a massive player on the global market?
Exactly, too, right there. Venezuela's less than 1% maybe worth of global supply, and in terms of global exports, there's only one destination market for all intents and purposes, and that is China. And specifically within that is the Chinese independent refineries, who for pretty much all of 2025 have been supporting Venezuelan exports and keeping values of volumes at that supported level. In terms of the time period, we are looking at some form of a resolution, maybe sooner rather than later. But what that really does is puts a little bit more pressure on the Venezuelan system as opposed to the Chinese and wider Asian system, because there is a huge amount of Venezuelan oil still on the water and within Asian waters as well. So it can sustain being imported into the Chinese system for some time for the next couple of months as well, considering the 60-day voyage period. In terms of the U.S. administration and the potential blockade, which has been announced now, there is, of course, news there that huge volumes and quite a few number of tankers have not actually exited Venezuelan waters, but also are, not even entering Venezuelan waters to come and pick up crude cargoes. So, yes, this is very quickly and evolving, but it somewhat looks at the geopolitical risk premium from a different angle, whether de-escalation on the Russia and Ukraine front could look at some slight ramp up here within the U.S. and Venezuelan systems.
You mentioned China there. I mean, a huge consumer of the world's oil production. How do you see the demand side evolving in some of those big importing countries like China and also like India as well?
Well, China has historically been the heartbeat of the oil market. Currently is, and for the next few years will continue to be so. Of course, with the 500,000 barrel a day year-on-year growth that has typically occurred within the Chinese middle distillate range. We are looking at somewhat of a plateauing over the next couple of years, and that essentially plays to what the yield profile within the Chinese refining system extends itself to, right? So we've seen a capacity deregulation there within the teapots and the independent refineries, but also a huge gain within the mega independent and complex integrated with petrochemical sites. Now, for India, it's somewhat different. India, we do see continuing in terms of its demand growth, and that is something we're seeing as a similar trend or trajectory with its refinery capacity increases to continue to meet its domestic demand and obviously, well, increase exports to the wider region and wider market. As we see Europe declining within the demand space, but the US also something similar on the flat level. Now, speaking on that from the refining sense, you know, there is a huge divergence. There has been for the last couple of years, accelerated by the peak of COVID, where we have seen the Western markets or the Atlantic basin reduce because of capacity rationalization. And we are looking at a bit more in terms of volatility of cracks there compared to what's happening with the Middle East and Asian system.
Look, you mentioned Europe. We've also seen Europe easing that ban on combustion engines heading into the next decade. Is that going to make any meaningful impact on the demand picture, though?
We feel there are some upsides and downside risks here, but for all intents and purposes, it looks like policy could change at any point. And of course, with the reintroduction of potential Russian volumes to the rest of the wider market, it could free up some other middle distillates to come into the European system. But in terms of the combustion engine part, we've seen here in the UK some policy change in the last 3 or 5 years, which has gone out till 2030 or 2035 as well. So yes, much rests upon the policy-driven arguments, and nothing for now, we would say, is absolutely certain for that 10-year period.
Well, the supply side keeps building up. We talked about that at the start. I'm just wondering, in the light of all that we've discussed just now, what sort of reaction do you expect to see from OPEC Plus in its next few meetings when it comes to deciding production quotas?
And that therein is the crystal ball question with OPEC Plus, right? So we have seen a huge global oversupply in 2026 of around 3 million barrels a day of crude, and something similar on total liquids. But if we assume OPEC Plus isn't looking at the flat price, right? OPEC Plus manages the backwardation such that it disincentivizes the traders to store barrels, such that when there is a demand increase, OPEC Plus, with its spare capacity, can pump more and meet that demand by its own selves. So the backwardation for Brent, WTI, even Dubai has narrowed considerably over the last few sessions. Yes, it has spiked, by 3 or 5 cents within the last couple of hours because of the US Venezuela. But moving forward, we are looking at OPEC Plus continuing to manage and protect that backwardation. What does that mean? From a barrels perspective, is we don't need more barrels. Right? The world does not need more supply coming onto the market if you look at where non-OPEC growth also is. So, yes, we are looking at potential continued flatlining in terms of a pause of unwinding of the cuts beyond Q1. But nevertheless, with the Russia resolution potential, herein lies the question of, yes, Russia can continue to produce more, and OPEC can think about maybe increasing more towards a market share towards the end of 2026.
Just also curious, just to wrap up, what's your outlook for US shale producers? How competitive is US domestic oil production at the moment?
Well, the US system shows a year-on-year flattish if you look at the deck, but if you're looking at growth within the year because of the seasonal and other factors, there is some slight growth. Now, moving forward, if we're looking at WTI at $55, 56 as we're seeing here on the screen, it doesn't reach a few break-even points, right? So we are looking at some consolidation within that space. But nevertheless, the US space with drill baby drill also requires SPR builds, so for essentially a fill baby fill. And within that, the US WTI light sweet is not the ideal barrel to fill the SPR with. So we are looking at some downside potential because of ducks. Ducks are not as high as during the first Trump administration. But we are looking at potential imports from other regions of the right quality of medium sour barrels to fill some of the SPR. And we've seen some evidence of that already with Saudi Arabian OSP's official selling prices dropping and being more lucrative coming into Europe and heading into the US systems as well.
All right, Janiv Shah, terrific analysis there. Thanks so much for joining us. Janiv Shah there of Rystad Energy. We have more to come. This is Bloomberg. Citadel founder and CEO Ken Griffin says Republican policies on tariffs and immigration are currently driving inflation. Speaking with Bloomberg in Paris, he thinks in the long run, their push for deregulation will ultimately stem those pressures.
The big picture is the American consumer is tired of the persistent and sticky inflation. They feel like they can't get ahead in a world where their savings and their wages are constantly deprecated by the impact of inflation.
Why aren't Republicans speaking to that? Is it an issue of not having the policies, of not communicating the policies correctly?
So I think it's actually fairly complicated. I think that the Republicans struggle with the reality that many of their policies, which they ran on, for example, ending illegal immigration into the United States, are actually pro-inflationary. Right? When you end illegal immigration, you reduce the size of the available workforce, that's pro-inflation. And so the Republicans are grappling with tariffs, another case study. You impose a tariff, it's a regressive tax on consumers. It's pro-inflation. So some of the very policies that the Republicans have put forth and have been successful in implementing are actually the very policies that tend to be pro-inflation. Some of the other policies, for example, deregulation, are just going to take longer to play out. And ultimately, deregulation, which should unleash productivity gains, will create a reduction in inflation, a very healthy reduction. But we need to get to that point in time.
That's Citadel founder and CEO Ken Griffin speaking there with Bloomberg's Danny Berger. Well, Tesla's shares paired some declines after the bell amid news that its sales in California are poised to be suspended for 30 days. And that is if it doesn't change its marketing practices that allegedly mislead consumers about its driver assistance technology. Now, before that news came out, we saw Tesla shares close their US session at a record high on rising optimism about the company's self-driving and robotics efforts. Let's get to Bloomberg Transport reporter Danny Lee in Hong Kong now. So, Danny, what are the specific issues that are facing Tesla in California?
Yeah, Tesla faces a 30-day suspension in its founding state of California. The California Department of Motor Vehicles specifically takes issue with Tesla's marketing practices, and that really revolves around its kind of description of its capabilities around autopilot and full self-driving. Now, this ban won't take effect necessarily for 90 days, and that gives Tesla the time to make its next move, either to respond, to comply with this ruling, or to appeal. As you said, though, the shares in post-market trading took a 2.2% hit before pairing gains to around 1%. But that does come after the news of Tesla shares hitting an all-time high at the close, and that makes it now worth $1.63 trillion. And as you said, the kind of optimism that investors have in Tesla's technology around and full self-driving capabilities, and also just its robotics efforts really helping spur the company on, particularly at a time when its core EV business is struggling. And really the contrast, especially with the likes of the European Union, revoking its ban on gasoline cars at 2035 could have an effect on someone like Tesla, as that momentum into EV sales perhaps does slow in a key market like Europe.
All right, well, if this sales suspension does take effect in California, what's the likely impact going to be on Tesla?
Yeah, well, California is Tesla's biggest market for sales and also home to one of its largest production lines. So there is a lot at stake in terms of sales and production, and also for the tens of thousands of people that Tesla employs in California as well. So there's a lot there at stake. However, Tesla will be off the hook if it stops using various descriptions around autopilot and full self-driving because, as California says, it doesn't meet certain industry standards. But Tesla has pushed back, saying that its marketing literature has been taken out of context and doesn't take into account the kinds of fair warning it gives to consumers. But this really, this skirmish with California just adds to the long list of issues it's faced with regulators federally and at a state level and with various agencies around its full self-driving capabilities.
Danny, you mentioned a little bit earlier there the shares closing at a record and the extraordinary market cap of Tesla as well. What's the outlook for the share price and what's the short interest like right now?
Well, there is momentum going into Tesla shares. I think it's practically doubled over a short period of time. We saw one point shares valued around 800 billion. So there is momentum, particularly as Tesla continues its transition under Elon Musk, back at the helm to focus on some of these more advanced tech, such as AI, robotics as well. So the momentum is very much with Tesla at the moment, and it really is a contrast given its struggles with its core EV business.
All right, Bloomberg transport reporter Danny Lee there. Let's check in on how the rupee is tracking because we saw it surging a little bit earlier after we got some support from the Reserve Bank of India, strengthening the most in 7 months against the dollar. Now, this is after the RBI sold dollars aggressively to support the currency. The RBI stepping in to intervene, selling, just trying to find that number for you. Can't, but let's just say the RBI stepping in to support the rupee. We have plenty more ahead. This is Bloomberg. Welcome back. You're watching Insight. This is a quick look at where markets stand at the moment. A bit of green on the screen compared to what we were seeing yesterday. Most of the major markets modestly in higher, better territory. The Nikkei kind of flat at the moment, seeing a pretty good bounce for the Kospi, though better by 1%. But the Kospi bore the brunt of a lot of the selling yesterday. We've got a modest recovery in crude prices as well, mainly due to the US blockade of oil tankers in Venezuela, but we'll see how enduring that price bump is because overall the narrative of oversupply weighs heavily on the oil market. Take a look at the Indian rupee in the corner of your screen there, strengthening notably after the Reserve Bank of India aggressively sold US dollars to support the currency, so that is having some impact. Let's see how enduring that is as well. Well, China's markets, meanwhile, are on track to deliver investors positive returns in 2025 as the nation's assets look to shed their uninvestable tag. Global fund houses such as BlackRock and Fidelity International say more inflows could be coming, which could help fuel momentum for the real economy. But beneath the surface, challenges, of course, do remain. Consumers remain downbeat heading into the new year. The property market continues to be stuck in the doldrums as well. So that leaves China's economy propped up by an ongoing export boom. Let's get a bit more perspective on the outlook for China's markets now with Vivian Lim Thurston, a partner and portfolio manager at William Blair Investment Management. Vivian, thanks so much for joining us. I just want to start, if I can, by taking a look at one chart which illustrates what's going on in China. We've seen mainland buying of Hong Kong listed stocks slowing pretty much to a trickle. Why the bearish sentiment, and do you see any end to this?
First of all, I think if you look at the China economy, which has been quite, I would say, mixed this year, one is that you can see the broad-based economy and consumption property market remain very weak. But on the other hand, you saw also the innovation-driven kind of industries, whether it's AI, autonomous driving, or biotech, start to show very strong fundamental improvements. So because of that, we see a lot of inflows heading into either Hong Kong markets both by the global investors and the southbound from the mainland China investors. So I think depends on how this tech-driven kind of growth shape out, and that would determine the future of the equity markets in China to a large extent.
Yeah, I mean, there's definitely weak spots in the China story, particularly around property consumption, deflation as well. But, to talk about some of the bright spots that you identify, I mean, particularly there's a lot of optimism around the China AI story. The surge that we saw in the MetaX on debut today was quite extraordinary. So can you tell us about what you're seeing in this space? How much upside is there?
Yeah. I think, first of all, China is still in the early innings of the whole AI development, in my view. If you look at both from the spending perspective and also from use case and also a broader kind of implication on the enterprise side, I think still quite early, especially compared to the global market developments. So from this perspective, I think there's still a lot going forward in terms of the growth and also duration of the growth. And secondly, I think the AI pursuit of China is also very much aligned with Chinese government's initiative to continue to find a new driver of the future growth of economy and also to pursue the self-reliance of the technology. So both factors, I think, will continue to support the AI growth in China. So from that perspective, I remain very constructive for the AI development and also AI-related stocks. Having said that, I think given that some of the stock has run very hard this year, we're probably going to see some consolidation phase. And that also will depend on how global AI spending is going through. And it's also about US Fed interest rate decision.
Now, when we talk about AI, particularly in the US context, we usually have a discussion around is it a bubble? There's often talk about some of these circular investment deals that go on as well. Now, I know that you don't see a bubble in China AI spending, but what spending developments do you expect to see in 2026? Could we see a hyperscaling China style?
I think we already see the emergence of the Chinese domestic hyperscalers. Those companies tend to be operating in internet industries, whether e-commerce, online gaming, and also some kind of telecommunication equipment industries. So it's not surprising that those companies are taking the lead in terms of pushing forward for the whole AI development. And I think at this stage, if you talk about bubble in terms of the spending, I think it'll be too early. But that bubble could be a different story in terms of the stocks. So those are two different, I would say, different developments. Fundamentally, I think China is still very early in the whole development. And I think we can see more and more both the spending on the further algorithm development of AI and more importantly of the AI hardware development, whether the chips are related kind of hardware supply equipment to supply the entire domestic AI ecosystem. And one thing I want to point out that China ecosystem on the AI front will be decoupling from rest of the world. And this is the nature of the whole digital development of China, which has always been on its own to a large extent. And then also because of the geopolitical risks, I think China will be further kind of go on the path on its own.
Vivian, you mentioned a moment ago you anticipate some consolidation in AI companies in China going forward. Can you tell us a little bit more about that? Where do you see that consolidation happening?
Yeah. As I just mentioned, that I think there is a lot of uncertainty related to two things. This is not just for Chinese AI development, also from global AI development from the stock perspective. Number one is there's always ongoing concern over the AI spending cycle, given that we have seen a very, very strong cycle in the last couple of years. So every quarter, I think we're watching very closely how global hyperscaler spending it's going through. So if that shows some kind of a slowdown, and I think that could trigger the weakness of the global AI trade, including China. And the second development, I think very critical, important, is about the U.S. interest rate decision. So if Fed rate cuts don't come through as much as the market hoped or expected, and I think that there will be a risk-off mentality among the investors. And then Chinese equity tend to be on the risk asset side that tend to be underperforming in that scenario. And also China stocks that I just mentioned tend to be the growth stock. and that tend to also underperform in such a scenario. So those two developments, I think, will be very important to watch in order to gauge how the China AI stocks perform going forward.
Now, away from the China AI story, where else do you see good opportunities in Chinese equities at the moment?
I would say overall, innovation-driven themes in China has become a very important opportunity set. And I think going forward, that will still remain the brightest spot of the market. As I mentioned earlier, that China has been on this kind of top two cities for some time, meaning that the broader base domestic consumption and product market is still in the very weak deflationary phase. Yet we see the brighter spots relate to the innovation themes, whether it's AI, whether it's autonomous driving, EV, biotech, pharmaceutical, all that continue to show a very strong kind of growth. And that also lead to increased export growth of China. So this side of the development will continue to drive the investment opportunities going forward. And that's where we tend to look for more opportunities. Having said that, I also think at one point, the domestic economy may find a bottom. If that happens, I think some of the more traditional kind of sectors, whether consumption, for example, may start to do a little bit better. But that is still very early. We haven't seen the bottoming sign yet, but it's something we watch very closely.
Yeah, we do need to talk about some of the risks and the weak spots as well. I mean, the property sector just continues to circle the drain. Deflation is an ongoing problem linked to weak consumer confidence as well. So with those factors in mind, how do you see earnings growth looking in China?
Again, I think you have to be very driven by country, by industry, by company. It has to be very specific. It's not broad-based. I think on a high-level aggregate basis, I think the current consensus expect 2026 Chinese equities earnings growth is about low teens to mid-teens. I think that is basically driven by a lot of those tech innovation-led industries and sectors, and also exports. But on the other hand, I do think some of the lagging industries start to see an easy base effect, and that could also help a little bit on the earnings growth front. But overall, I do think the property market slowdown is structural in China, and then this actually also reflects that Chinese government want to tackle this structural issues, which was very much in the bubble state, even starting from probably 7, 8, 10 years ago. So that, I think, will not change. But the unknown is, without the property market growth, how can Chinese economy find a new growth driver, whether to support the confidence of households and also the confidence of business? That remains to be seen. So I do think tech innovation could be the potential driver. But so far, I think the size of those industries, the contribution to the total growth, still not as meaningful as property market at the peak time of their impact to the economy. So we'll see how this play out, but definitely we see the green shoots of those sectors start to take a bigger lead on the economic growth.
Vivian, before we let you go, I'm just wondering if you feel Chinese asset prices are accurately reflecting potential stimulus from the government at the moment.
Yeah. I think the market expectation for this large stimulus probably already very, very low. We have been on this path to expect bigger stimulus for at least 3 years now, as it has not come. And I think market already come to realization that maybe the Chinese government would not give out this massive stimulus, especially on the property market or some infrastructural kind of a project as they did in the past. Instead, I think they want to be more targeted at the stimulus, such as support the EV purchase, the appliance upgrades, smartphone purchase. So those will continue to come through or renewed in the new year. But I think it may not be enough to make the market feel, oh, we see a great stimulus. Given that there is no expectation, I think, in the current pricing of the Chinese equity market, I don't think it will be market will be disappointed if it doesn't come through. So if you look at the forward PE of the MSCI China, it's a 12 times forward PE, which is still quite attractive compared to MSCI EM, which is about 13 times, and very attractive compared to S&P 500 with 22 times. And then if you layer that with the low to mid-teens kind of growth in 2026, actually that set Chinese equity up for a pretty favorable kind of position.
All right, Vivian, thanks so much for joining us today. That was Vivian Lynn Thurston of William Blair Investment Management. Here are some more of the top stories that we're following out of China. Bloomberg has learned that China's Luckin Coffee is considering a bid for Nestlé's Blue Bottle coffee to boost its brand profile and expand in the premium coffee segment. Sources say Luckin is also evaluating other acquisition targets, including the operator of percentage Robeco coffee stores in China. Founded in 2017, Luckin has expanded with thousands of stores offering low-cost coffee, surpassing Starbucks in store numbers in China. China Vanke has unveiled a revised bond extension proposal for creditors to vote on as it makes another attempt to gain support for a plan to avoid default. The company is offering to pay 60 million yuan in interest due on December 15 by the end of Monday and is proposing to extend its grace period to 30 trading days. Vanke is scheduled to hold a bondholder meeting on Thursday to discuss the latest proposal. And China is currently building one of the world's largest hydroelectric dams in one of the most earthquake-prone regions on the planet. The dam in Tibet is set to cost $167 billion. It could take at least a decade to finish. And it comes with a set of challenges. Bloomberg Originals takes a look. Here's a preview.
From the glacial melt here, the Yarlung Sangpo River flows over 1,000 kilometers east along the edge of the Tibetan Plateau, before performing what many consider a geological miracle at a location known as the Great Bend, right where the plateau meets the Himalayas.
雅夏水电工程体量大、周期长、影响远。
It's at the Great Bend in Medog County, Tibet, where construction of the Yasha or Lower Yarlung hydropower project officially began in July 2025. It's a place so remote, a road only reached it in 2013.
The energy generation from this project will break like records in like many different dimensions. It will be by far the world's largest individual source of energy, 60 gigawatts of installed capacity.
The Chinese government has said that this will generate about 300 billion kilowatt hours a year. That's more than the UK uses an entire year. It's also about 3 times more than the Three Gorges generates.
Unlike a traditional walled dam, observers believe this one would be made up of a series of hydropower stations along the river. Theories vary, but some outside experts suggest there would be one upstream dam with a large reservoir to regulate the water flow. This would be followed by a second smaller dam at the top of the gorge, where water would be diverted from the Great Bend through the mountains via a number of underground tunnels and turbines, before potentially entering another smaller re-regulation dam at the bottom of the gorge. This could stabilize the flow before the river continues downstream into India.
And subscribers can watch the full documentary about that on the terminal and on Bloomberg.com. More to come. This is Bloomberg. We're keeping an eye on central banks in Thailand and Indonesia later as they make their last rate decisions for the year. Both countries are facing economic and political challenges. Indonesia is facing an exodus of foreign investors concerned about slowing growth and costly government programs. Meanwhile, Thailand has been hit by a series of shocks, from US reciprocal tariffs to a deadly border clash with Cambodia. So for more on those decisions, let's get to our team. Joining us from Bangkok is our bureau reporter Patpicha Tanaka-Sempipat, and covering Indonesia for us is our Southeast Asia economy reporter Claire Zhao. So Patpicha, let's start with you. What are we expecting from this afternoon's Bank of Thailand meeting?
Paul, like you said, this will be the last meeting for the Bank of Thailand for this year, and the BOT is going to go into that meeting considering a bunch of factors, including a weaker growth outlook for next year, the impact of U.S. tariffs, as well as this baht, which has hit a 4-year high and rallied so high that it has hurt exports and tourism. what we're looking at is basically a fifth cut in 14 months or a second consecutive hold. And most analysts are expecting that the BOT will actually cut policy rate by another 25 basis points down to 1.25%. And this will come after a hold in October, which was unexpected and interrupted an easing cycle that already cut 100 basis points since October last year. And it's also possible, though, that the BOT might wait a little bit before it starts easing again, considering that they have limited policy space right now and Thailand has an election coming up in February. So if the BOT waits a little bit, it can decide what to do with the policy rate again in the next meeting at the end of February, which will come after the election that is set to take place on February 8th.
Yeah, that snap election did inject another variable into the situation. How's that weighing on the economy?
So since Prime Minister Anutin dissolved Parliament last week, the government has stepped into a caretaker capacity, which has limited fiscal capacity. So all fiscal policy plans are being shelved until a new government takes over, which will probably be 5 or 6 months from now. And that heightened political uncertainty is really not good for Thailand, a country that has seen recent bouts of political turmoil and 3 short-lived administrations since its last election that was just in 2023. And this political turmoil actually has weighed a lot on the economy already. And the economy is now projected to grow only 2%, around 2% this year. And that is less than half the pace of many neighboring countries like Indonesia, Vietnam, and the Philippines. And that has also eroded investor confidence very much. And foreign investors have sold more than $3 billion worth of Thai stocks so far this year. And that has sent the benchmark SET index down nearly 10%. And it is now Asia's worst performing bourse.
Yeah, also one of Asia's best performing currencies, though, the baht, very strong. What's the Bank of Thailand's view on that?
The BOT is actually having a lot of headache with the baht strength and actually has issued 2 statements so far about the baht within the last 2 days, which is very unusual for the BOT. The baht has rallied 8% this year and, as I said earlier, just hit a 4-year high. And that has hurt exports and tourism, which are the two key drivers of the economy. The Vitai Ratanagon, the BOT governor, has said that the baht should actually be weaker to reflect economic fundamentals. And he said that the central bank will step in to manage the baht excessive volatility. And so this underscores the pressure that the BOT is coming under to address and tackle the baht strength, as well as pressure for it to consider cutting policy rate to help ease the pressure from the baht gains.
All right, Claire, let's get to you in Indonesia. Also a rate decision there and a different set of problems for the central bank to consider.
That's right. Currency is also a big headache for Bank Indonesia, but for the exact opposite reason. The rupiah is the second worst performer in Asia so far this year, and that's going to be top of mind for Bank Indonesia as it meets later today. If we follow Governor Periwarjio's recent signals, he said the short-term priority of policymakers will be maintaining that currency stability and stemming the foreign outflows. So if we follow those metrics, we should see a hold today at 4.75%. The rupiah is still 0.2% down this month, while the rest of Asia, most of Asia, has gained. That being said, we can't really rule out a 1/4 point cut today as well, because if you look at it, the rupiah weakness this month is not as bad as other months. And one thing that could build a case for a rate cut is the economy needs a boost after the severe flooding seen in Sumatra Island in November. With the flooding, that could affect agricultural output, economic activity, and it could use a little bit of a lift from another rate cut. We should remember that Bank Indonesia is not averse to surprising the market. Half of its decisions this year have been surprises, and a lot of people still think a cut could be live for today.
Despite this, we still got foreign funds continuing to sell off the rupiah. What's going on?
Yeah, foreign investors are still heading out the door. a big factor there, first, of course, is the currency weakness. That's already a huge risk. But some fundamental issues are also emerging in Southeast Asia's largest economy. Top of that is fiscal prudence. We have a recently appointed Finance Minister Purbaya who's unleashed several waves, billions of dollars worth of stimulus to help the economy. But that's coming at a time when revenue collections are pretty weak because of weak commodity prices and the weak economy as well. And so a lot of investors are worried, even though he has assured that he will be prudent. There's talk that Parliament could review a law that caps the budget deficit at just 3% of GDP. So if that comes to pass, we could see a much bigger budget deficit in the coming years, much bigger deficit spending. Other than that, comes on top of issues in the economy such as weak consumption, weak job creation, and also stalled U.S. tariff talks. So for foreign investors, there could be safer bets elsewhere.
All right, Bloomberg Bangkok reporter Papicha Tanaka-Sempipat and Southeast Asia economy reporter Claire Zhao. Thanks for joining us. Before we go, let's take a quick look at our guests for tomorrow. Zuma Wealth joins us to talk markets and share their investment strategy. Also, SEB will be with us as we look ahead to Friday's Bank of Japan rate decision. But that is it for Insight. Horizons Middle East and Africa up next. This is Bloomberg.